When equity markets plummet, a chorus of seasoned and amateur voices rises to shout a common refrain, "Buy the dip." This idea, rooted in the historical resilience of equities and the intuitive appeal of getting a bargain, falls under a broader philosophy of contrarian investing. Contrarians by definition swim against the current. They buy when others sell, scooping up battered assets while the crowd flees. Behavioral finance offers elegant theoretical support for this approach, painting pictures of herding behavior, market overreactions, and emotional contagion. Yet for all its intellectual sheen, contrarian investing is a nuanced, multifaceted strategy. It is neither singular in its execution nor universally applicable. This video dissects 4 significant contrarianism variants: knee-jerk, technical, constrained, and opportunistic, and explores the psychological traits required to apply them effectively. In doing so, we aim to clarify what makes contrarian investing work, when it breaks down, and how investors can approach it with both strategic rigor and self-awareness. Knee-jerk contrarianism is perhaps the most instinctive and widely practiced form of dip buying. It operates on a simple heuristic: if it's down, it must be a bargain. Whether applied to the broader market or individual stocks, it rests heavily on faith in mean reversion, the idea that prices eventually return to their long-term averages. The historical data often cited to support this strategy is compelling, particularly in the US market. Over long horizons, equities outperform virtually all other asset classes. This statistical edge feeds the belief that downturns are temporary and that perseverance will be rewarded. However, this conclusion hides 2 critical flaws. First, the data suffers from survivorship and geographical bias. US markets may have recovered, but Japanese equities, for instance, offer a sobering counter-narrative. Second, recovery times can be excruciatingly long. The Great Depression wiped out decades of wealth, and it took until 1954 for a 1929 investor to be made whole again. Empirical finance adds layers to this story. DeBont and Thaler's 1985 study on loser stocks showed significant outperformance following sharp drawdowns. But later work by Jagadish and Titman, 1993, found that momentum dominates in shorter horizons. What you buy may keep falling before recovering, if it ever does. Buying the dip, it turns out, is often an exercise in catching falling knives. This risk is amplified at the stock level. Entire sectors, like biotechnology or unprofitable tech, can dominate the losers list in any given correction. Within those, some businesses are merely out of favor. Others are structurally impaired. Without differentiation, knee-jerk contrarianism is a recipe for pain. Technical contrarians agree with the principle of buying weakness, but wait for supporting signals from charts and indicators. They look for bottoming patterns, oversold readings, and signs of capitulation, believing that crowd behavior leaves footprints in price and volume data. While technical analysis has long been derided as pseudoscience, modern quantitative research has given it some academic credibility. Studies by Lowe, Mamaisky, and Wang used computational pattern recognition to identify consistent formations, double bottoms, head and shoulders, and more. However, the incremental returns were often modest and barely sufficient to cover trading costs. Still, tools like the VIX or Relative Strength Index can serve as proxies for sentiment extremes. A spike in the VIX often corresponds with panic selling, after which forward returns tend to improve. But these signals are probabilistic, not predictive. In short, technical contrarianism offers a more refined entry framework than its knee-jerk cousin, but it's no silver bullet. Enter the value investor. Constrained contrarianism tempers the impulse to buy the biggest losers by layering on financial screens. Investors seek companies that are down, but still profitable, relatively unlevered, and possibly even dividend-paying. The goal is to avoid value traps, stocks that are cheap for good reason and get cheaper still. The research affiliate study supports this approach, showing that combining value with quality enhances returns, particularly for cheap stocks. Measures like low PE ratios, positive dividend yields, and modest net debt to EBITDA ratios help identify resilience. But these metrics are based on historical data, which may not capture looming structural shifts. A company disrupted by AI or geopolitical upheaval can still look healthy on a spreadsheet until it doesn't. Even so, this method remains one of the more defensible expressions of contrarianism. It narrows the field of potential buys and introduces a degree of fundamental robustness that purely price-based strategies often lack. The most elegant form of contrarianism is also the most disciplined. Opportunistic investors keep a watch list of high-quality companies they'd love to own, but only at the right price. When markets sell off indiscriminately, these investors revisit their valuations and strike. This strategy was exemplified during the post-March 2020 rally, when companies like Nvidia and Apple briefly looked underpriced relative to intrinsic value. The same pattern held with Microsoft in 2014 and Meta during its metaverse-driven fall from grace. The key is to distinguish between transitory panic and real impairment. This approach requires preparation and patience. Valuations must be rerun in light of new risks and revised forecasts. Opportunistic contrarianism is not reactive, it is proactive. It waits for the market to offer a moment of mispricing and then acts with quiet confidence. Contrarian investing is not merely an analytical challenge, it is a test of character. To succeed, one must possess a contrarian mindset, comfort in discomfort, immunity to social validation, and a tolerance for isolation. A long time horizon. Markets do not reward patience on demand. Investors must wait as long as it takes. A strong stomach. Markets can fall further even after you've bought. Faith can be tested. Without resolve, even good decisions can lead to poor outcomes through premature exits. These qualities cannot be taught easily. They must be cultivated or recognized as absent. Knowing your own emotional thresholds is as important as understanding valuation. Contrarian investing is not a monolithic doctrine, but a spectrum of strategies, ranging from the crude to the calibrated. Each variant offers its own promise and peril. What unites them is a shared intuition that markets, for all their efficiency, can become emotional and imbalanced. But this is not enough. Data, charts, and valuations are tools. The real arbiter is temperament. For some, contrarianism will yield outperformance, for others, frustration. The lesson is not just how to invest against the crowd, but whether you should. The contrarian's compass, then, must include not just external indicators, but internal awareness. For only those who know both the map and themselves can hope to navigate the fog of fear and opportunity.